Good morning and welcome to the Forex Daily Update, brought to you by Pepperstone on Monday the 21st of January 2019. I'm Darren Sinden and you can follow me throughout the day on Twitter by using @DS_Pepperstone. Okay, let's kick off with a look at the overnight changes and price moves to be aware of. But as it's a Monday, of course, we'll look at things from a weekly perspective. And a few things that have caught my eye here. First of all, euro dollar retracing down by around 0.85% against the US currency over the last week, trading at 113.7870 shortly before we recorded the video. Actually up on the day, but it's a longer term trend that we're interested in this morning. Speaking of longer term trends, over the last week, the Kiwi, the New Zealand dollar, has lost 1.38% against its US rival, trading this morning at 67.2950 shortly before we recorded the video. There were gains also for the dollar against some safe havens, and the one I flag here is the Swiss franc, where the US dollar was up by 1.5% across the course of the week. I think that says more about the state of play in Switzerland than it does about the dollar, but also perhaps showing us that risk on is emerging as the dominant trend in the market over the near term. The Brazilian real gave back some ground against the US dollar, gave up 1.06% last week to trade at 3.75 just before we recorded the video. But of course, the real still up over the month, up by around 3.78% against the dollar in that time frame. Dollar index for its part, 96.26, trading shortly before we recorded the video, up by around 0.7% over the course of the week, although it didn't really feel like that. Last week it felt like the dollar was pretty static. Nonetheless, we start this week at 96.26, and let's see where we finish on Friday. Okay, what's on the calendar then? Events that may move the markets today. First of all, just note that it's a holiday in the US, or at least a partial holiday. It's Martin Luther King Day there in the USA. We've already had some data out of the UK first thing this morning in the form of Rightmove house price data for January. We also saw new home sales in Australia for the month of December, and we'll look at that data in a bit more detail momentarily. We then saw a raft of data out of China, including retail sales, industrial production, and perhaps most important of all, GDP for Q4 2018. To come this morning, we shall have producer price index data out of Germany for the month of December, the Bundesbank monthly economic report, a chance to look at the state of play in the German economy as far as the Bundesbank is concerned, and then at 16:30 today, 3 and 6 month T-bill auctions out of the USA. It's a very light calendar, of course, in respect of that US holiday, and of course the US government shutdown also deferring some data points as well. Okay, breaking news and comment then that's caught my eye overnight and over the weekend. First of all, China's Q4 2018 GDP comes in at 6.4% per annum and below the 6.5% per annum seen in Q3. This was the slowest rate of growth in the country since the global financial crisis 10 years ago, and by some measures since 1990. Food for thought there then. Australian new home sales fell sharply in December, posting their biggest dip for 6 years at minus 6.7%, and that compared with a plus 3.7% growth that we saw in November. The World Economic Forum meeting in Davos begins today, but begins without Presidents Trump, Macron and UK PM Theresa May, who are staying at home and focusing on domestic issues in their own country. Okay then, food for thought and something to take away with you into the trading day and beyond, and why not think about this? The question I've asked here is, will US equities continue to outperform the rest of the world? Obviously, US stocks have had a bumper start to 2019 after a very rocky finish to 2018. A couple of charts here from Bank of America Merrill Lynch's flow show report, just to add some background to the question. First of all, Bank of America believe that global profits have yet to trough. They plot global earnings per share, 12-month forward, against their own in-house model in yellow. Merrill Lynch believe that we can still see a further dip in global profits, and therefore rest of the world equities might still discount some of that and sell off further. But to the flip side, they point out that relative to their global peers, US stocks are now at 70-year highs. Now, of course, this is probably driven by the sort of divergence in the expectations of fortunes around the global economy. And as we've just seen, that China data will probably only add to this. But at some point, presumably, these US stocks should run out of steam. Maybe Q4 earnings season, which we're in the middle of now, is the time for that to happen. Okay, time to read the risk warning. Trading CFDs and foreign exchange on margin can be a risky business. If you're in any doubt about those risks or the suitability of leverage products for you, then please do contact your Pepperstone account representative, who will be happy to take you through that. And please do read this risk warning thoroughly. Thank you for your time.